started. Welcome to Market News International's June webinar, Making Sense of Muni Market Uncertainty. I'm Lauren, Marketing Manager for M&I, and today I'm going to give you a very brief overview of what we do at Market News International. Yali and Di, our featured reporter, will speak for about 10 minutes on the current muni market environment. All of that will be followed by a question and answer session. If at any point during Yali's presentation you have a question, you can enter it in the chat box or the Q&A box over to the right-hand side of your screen. And you can address the questions to either myself or Yali, and we will try to get to you, time permitting. You can email us with questions after the webinar. You can email Yali for questions about the content, or email me for a recording of the webinar or the slides used. We'll have our contact information available at the end of the presentation. So about Market News International, we are a subsidiary of the Deutsche Börse Group and the leading provider of news and analysis specifically for the global foreign exchange and fixed income markets. We're one of 4 real-time English language financial news agencies with press credentials recognized by governments and central banks of all major economies. We offer exclusive monetary and fiscal policy reports, economic indicators and forecasts, and marketing interviews with key central bank and finance ministry officials, government policymakers, and economists. Our 60 full-time journalists are located in 12 news bureaus across Europe, America, and Asia, many of which are former fixed income and currency traders and strategists who know the markets and combine economics expertise with meticulous financial journalism. Today's featured reporter is Yali and Di. Yali has been with M&I for over 12 years, originally covering economic indicators, bond markets, and news from the Bank of France and the French Finance Ministry out of our Paris bureau. Then she joined our Washington office in 2001, covering economic data, and has since made her way to Deputy Bureau Chief for News. Yali originated an ongoing series of portfolio manager interviews that examine changing strategies of great interest to anyone managing money. During this webinar, she'll aim to help you make sense of muni market uncertainty, distinguishing headline fears from real threats and fundamental trends. And with that, I am going to turn the presentation over to Yali.
Thank you, Lauren. Let me start by saying that the recent flow and yield trends reflect a turnaround in the 2.9 trillion muni market. Trends are showing diminishing concerns since the beginning of the year, heightened fears of potentially significant state and local government defaults. The yield on a U.S. Muni AAA rated bond, for instance, was around 2.62% early today or in early afternoon, compared with 3.42% at the end of December. Have also shown a return of investors to the muni market since May. Still, it's unclear whether this is just a pause or the beginning of a longer-term recovery. For fund data provider EPF Global, for instance, retail investors are coming back and are here to stay. But for bond giant investor PIMCO, retail investors will likely continue to shed their muni bonds for some time, though at a diminished rate. So how to make sense of this muni market uncertainty? Many factors at play, but default supply and tax trends are key. Regarding defaults, are we talking about a systemic contagion or only isolated defaults? Take a look at state budgets first. According to the Center on Budget and Policy Priorities, nationally, states are projecting shortfalls for the coming fiscal year, which will be 2012, starting at the end of on July 1st for most states, totaling 112 billion. And shortfalls are expected to continue through 2013. Finally, states will virtually run out of Recovery Act funds at the end of June, meaning that such funds will no longer help offset part of their budget shortfalls. That said, states have too much to lose to risk a default given the tremendous long-term political and financial consequences for those borrowers who need the market to finance their projects. Second, states have the ability to strengthen their tax base. Besides, Fitch notes the latest revenue trends have shown receipts actually topping states' expectations Today, Treasury Secretary Timothy Geithner said that revenue is starting to come back as growth recovers, which means that the pressure is going to be more manageable for states. And third, they're also taking measures to reduce spending to meet their obligations to balance budgets. They are freezing hiring, laying off, or cutting services. And finally, pay and healthcare issues are real and sizable, but they can be addressed over the long term. The Center on Budget and Policy Priorities believes that longer-term issues related to bond indebtedness, pension obligations, and retiree health insurance can actually be addressed over the next several decades. So now, let's look at default and downgrade expectations. Defaults are higher than they have been historically. They still remain rare, and there has been no widespread downgrade so far, and trends are down. According to DWS Investments, for instance, which refer to the Income Security Advisor, as of May 11, there have been 14 payment defaults totaling $605 million of par value. And if trend continues, WS Investments estimates that there could be 39 defaults this year, totaling $1.7 billion. That in stark contrast with, for instance, analyst Meredith Whitney's expectation of billions of dollars of default, or she doesn't specify the time frame. Finally, rating agencies see more risk of downgrades than default. Moody's, for instance, the note will default on its general obligation debt, and at the local government level, defaults are likely to increase modestly, but are expected to be neither widespread nor systemic. And local government's problems are related to revenues and spending, not debt. And annual debt costs remain below 8% of states and local government budgets, according to Moody's estimates. And finally, Moody's also notes that regarding bank facilities, any failure from municipal issuers to extend their expiring bank facilities or find alternative financing is likely to be, quote, a prisec, describing the current situation as being so far so good. Even Standard & Poor's estimates that a majority of state and local government issuers rated by the agency will likely remain medium to high investment grade, and the rating agency also expects that there may be an increased number of rating downgrades this year, but the majority of state and local government issuers will likely retain solidly medium to high investment grade ratings. And finally, the last big rating agency, Fitch, estimates that a significant credit deterioration would likely be over multiple years. Nonetheless, downgrades rather than default are likely to be the biggest risk to municipal credit this year. Well, that said, defaults are clearly a threat. Municipalities and small issuers do not benefit from a tax subsidy, for instance, putting them more at risk. And revenue bonds are also at risk, as some are particularly exposed to sectors that can be very sensitive to the state of the economy, which for now is in a very soft patch. And in particular, land and housing-backed bonds are the most at risk, especially for issuers that came to the market between 2005 and 2007, is the message we get from both investment companies and rating agencies. And on the other hand, essential services revenue bonds tend to have strong ratings and are favored by investors. So all vigilance is definitely needed. The economic recovery is still uneven, with real estate struggling, affecting revenues, especially property tax revenues, which account for a large share of municipalities' receipts. Employment also remains an issue, and against this backdrop, land-backed revenue bonds are at risk, according to investors and analysts alike. That costs only represent a small part of muni budgets, as I mentioned earlier, and this strains the issue to revenues and spending. And then local governments are taking very strong measures to increase revenues and cut spending, and they are genuinely trying to avoid default. And that seems more likely than default, according to rating agencies. An issue that arose was the issue of state bankruptcy law, but it's almost out of question as states themselves oppose the introduction of a bill that would allow them to do so, and the simple prospect of that possibility, they argue, would damage their credit worthiness and increase investors' fears. So the message overall that I get from investors and many analysts is that while defaults are higher than they have historically been for municipal issuers, they remain low and are not a systemic threat. So what's the supply factor? Steve Musko, head of the Municipal Securities Division, Michael Decker, told me in a recent interview that supply so far has been rather thin in the muni market, and he expects it to remain that way this year, and he's not the only one. For now, muni borrowers are taking advantage of attractive yields, but according to Steve, we are unlikely to see a spike in issuance that will lead to the kind of volumes that we saw last year. Besides, the Build America bond issuance last year boosted supply, allowing some municipalities to move forward in financing some of their projects, and so they can now stay on the sidelines for those projects. And finally, spending control is also slowing projects, hence they need to finance them. However, while there is still a demand for yield, Municipal Market Advisors Managing Director Matt Fabian warns that a breakdown in demand at present could mean strong underperformance. So while it remains to be seen how supply will be absorbed overall, especially when headline fears resurface, the thin supply is a positive factor for the muni market. So let's turn to the tax trends. On this side, the end of the Bush-era tax cut will translate into higher taxes, with top bracket especially exposed, and this is support for demand for munis. It should support demand for tax-exempt bonds. But will the exemption actually from federal taxes on interest on muni bonds be maintained? With that limit hike debate and the focus on restoring a sound fiscal position in the U.S., the tax code has been targeted by lawmakers with a growing push in favor of taxing all interest on muni bonds. Senate side, for instance, the Wyden Coates proposal was introduced on April 5th. And Senators Wyden and Coates proposed that muni bonds lose the tax-exempt status of their bonds and instead receive a federal subsidy to their interest rate costs. The bill referred to the Senate Finance Committee, and the proposal would make all interest on state and local bonds taxable after 2011. The House side, Representative John Tierney said in April he would introduce the Tax Equity and Middle Class Fairness Act to eliminate the tax expenditures. That said, the bill has yet to be introduced. The proposals overall would grandfather existing bonds, increasing the likelihood to create a two-tiered market between existing bonds and new bonds, the existing bonds benefiting from a very strong demand. In addition, the report of the National Commission on Fiscal Responsibility in December, titled The Moment of Truth, also proposed to make interest taxable as income for newly issued muni bonds. And giving ground to this approach, a study from the Congressional Budget Office estimates that the tax exemption for state and local borrowings will cost the federal government $161.6 billion between 2010 and 2014. What would be the impact of the elimination of the tax exemption on the muni market? Likely bring more institutional investors, as we saw with BAB issuance, since the advantage would no longer be the primary driver for investment decisions. It is unclear, however, whether the shift in the investor base would translate into a larger muni market overall or not. So how likely, however, and how realistic is the elimination of the tax exemption? Well, if it ever happens, the end of the federal tax exemption is definitely not near. The legislative process alone would take months, if not years, as municipalities will fight the elimination of the tax exemption as well as the financial industry, probably. So, as a conclusion, I would say that the message that I hear from investors, analysts, or rating agencies is that isolated defaults are the most likely scenario, but vigilance is needed. Legislative developments in relation to the tax code will be important to follow, as there's a strong drive right now in after debates are going on. Land-backed bonds are especially at risk given the ongoing weakness of the housing market, and hand risks remain in the form of new dire predictions, for instance, such as those made by analysts Meredith Whitney or through new state and local government budget developments. And of course, it remains to be seen how the new market will react to a rising interest rate environment down the road and possibly higher inflation.
Okay, Yali. We did receive one question, and that is, if defaults are not a systemic threat to the muni market, what is the biggest risk?
Well, that is actually a question that I asked PIMCO, and their head of credit research estimated that repricing is the biggest risk for the muni market, where investors have traditionally invested without discerning too much within that market between issuers and individual investors. So the PIMCO said that once they fully realize the investment is not without risk, they might just simply ask rewards.
Okay, thank you very much.
To stop here.
All right, thanks, Holly. M&I next webinar, The Coming Fiscal Showdown, Deficit Reduction and the Debt Limit, led by our congressional correspondent John Shaw, will take place on Wednesday, July 20th at 4 p.m. Eastern Time. The webinar will focus on the looming showdown on Capitol Hill on U.S. fiscal policy as Congress attempts to come up with a 10-year deficit reduction package of at least $2 trillion and increase the debt ceiling all by August 2nd. John, update on the status of budget negotiations between the White House and Congress. In the webinar session today, you'll be immediately redirected to the registration page, or you can always register later by visiting marketnews.webex.com. And as promised, I'm going to leave this slide available. This has our contact information. You can, again, email Yali with any questions that you have on the content of today's presentation, and you can email me, Lauren Elahand, at marketnews.com for a recording of today's webinar or a copy of the slides used in today's presentation. I have also left our phone numbers on there, and you can follow us on Twitter at MI News or search for us on Facebook, LinkedIn with Market News International. Thank you much for attending, and we hope to see you at another MI webinar soon. Thanks.